Hey guys, Joe here from Avalon Accounting, and today we are talking about the book that I wish I had written. This is Simple Numbers, Straight Talk, Big Profits by Greg Crabtree. And this book is so good, we refer to Greg as Lord Crabtree around Avalon, and we also gift this book to every one of our new clients. So what I'm going to cover today is the 4 keys to unlock your business potential, as Greg puts it. I'm just going to call it 4 key takeaways that you can implement in your business to help you, understand your financials better and grow a really profitable business up to maybe up to 5 million in revenue. We'll see. But yeah, stay tuned for that. All right, so let's get right into it here. So key number 1 is owner's salary, and a lot of business owners get this wrong. And the reason is, and why this is so important, is that if you're not paying yourself an owner's salary at the right amount, your profit number is going to be jumbled. It's either going to be way too high or way too low, depending on what you're paying yourself. So really key, critical point to understanding what your profit is to pay yourself or somehow take into account what your market salary would be. So there's a few ways to go about doing this, and one of the ways is just to say, what would another company pay me for the work that I'm doing? What's your opportunity cost for running this business, and what you could earn somewhere else for that kind of work? So that's one way to look at it. Another is what you would pay somebody else to come in and do the work that you're doing. And that can be a really challenging thing because you're obviously doing a lot of things as an owner that you would never really ask another person to do, another employee. So that is a consideration there. But just keep in mind that just because you're doing a little bit extra doesn't mean that's necessarily part of your market salary. So you can think of it like this. If you're underpaying yourself, you're putting sort of your time or your opportunity cost into sweat equity, into growing the business and earning more equity within it. And if you're, doing extra stuff, that's just another way to account for that extra time. You're building the business to have more value. And a really good way to think about this is to delineate the 2 hats that you wear. Yes, you're an employee of the company, you have to do stuff within it, but you're also an owner and you want return on what you own. So coming up with this number can be a little bit challenging, but I really encourage you to come up with something that's not too high, not too low, so you can at least understand what your true profit is. One of the pitfalls here, and I want to warn you against, is I've had clients that have read this book and all of a sudden said, hey, I'm worth $120,000, and start paying themselves that the next day, even though their business couldn't really afford it. So don't fall into that trap. It can be a challenge to hold yourself back from that, but really key to give yourself your market salary to understand your true profit in your business. All right, so that brings us to point number 2, or key takeaway number 2, which is your profit, what your business is actually earning for you. And the nice little quote in here, and I don't think he wrote this, although he put it in there, is that revenue is for show and profit is for dough. And real business owners make profit in their business. So a really key to understand that. Revenue can be a vanity metric if you're not producing profit at the end of it. If you're just growing your revenue at all costs, you are still not running really a successful business. So that's something to just keep in mind. But profit doesn't really happen by accident. We need to be very, very intentional about how we're producing profit in our businesses, how we're turning that revenue into cash into our owner's pocket. So there's a few ways to go about this, and I'd like to give you a framework on how this really works in the real world. But we start with revenue, of course, all the money we're taking in from our customers, but then we subtract any direct costs right away. So anything that you have to spend just to produce that profit or service that revenue is a direct cost. So that could be labor or machinery or whatever kind of business that you're running. Could be just purchases for your online Shopify store or something like that. But these are direct costs related to the sales that you make. You don't have necessarily a ton of control over them, but you really do need to watch your margins on that. So that's your gross profit. Then you have overheads after that. So that's things like rent and accounting and marketing and things like that that are not directly associated with that revenue, but are just the costs of running a business. and then what's left over is your pre-tax profit. And this is really where, if you're going to be a successful business owner, you really need to focus your efforts on, okay, how does this all come together so that I have pre-tax profit? Everything after that, taxes and interest often is really outside of your control a lot of times, so you don't really take that in consideration. What you're focused on really is pre-tax profit. So to get to that pre-tax profit, one of the key elements of that is understanding our direct cost structure and making sure we keep close tabs on that, so that as we grow, we're producing more gross profit, not staying level because it's costing us more to produce that revenue. So that's a real key one. And the other is overhead. So keep in mind that if you're under $1 million in revenue, your overheads are often quite a bit higher as a percentage of revenue than they will be when you're over $1 million in revenue. So under $1 million, it's really hard to absorb those costs properly within that revenue size, but they don't grow proportionately with your revenue once you hit $1 million. So you'll start to see sort of overhead as a percentage shrink if you can keep a good eye on it. And what that means is just as you grow, if you can cover those two things off, then you're going to have more and more profit percentage as you grow, which is really what we want. All right, so the number 3 key is labor productivity. And if your eyes just glazed over when I said that, please stay with me. I'm going to keep this as high level and fun as possible. All right, so in any business, labor can be the most challenging thing to keep a cost structure on, because as we grow, we get less and less in tune with what's actually happening at the ground level. And you can think of it like this: if you're less than $1 million in revenue, you can keep a pretty close eye on what everyone's doing, kind of make sure they all have work, make sure they're working efficiently. But once you grow beyond $1 million in revenue, that's going to be much, much harder. You can't stretch yourself to understand what everybody in your business is doing at all times. So a trap that business owners fall into is that they're busy, and because they're busy, they hire. And that can be a real struggle for business owners that are growing, is that they think because they're busy, they should just hire, when there's another way to approach this problem. And that way is really to look at labor efficiency and productivity and look at each hire a little bit differently. So you can categorize people in sort of 2 ways, and there can be blends sometimes of how these people are hired and what they're hired to do, but generally try to think of any hire that you have coming on as either a production person or a not production person. So it may be a production person being the person at the till that's really bringing in sales and being productive, and then maybe back office staff or administrative staff as being non-productive. The reason we do that is because you have a revenue producing person, and then you have a person that's supporting that person, so it gets a bit tertiary. So the way to think about any of these hires is, do you have enough work for the production people? Can you keep them busy? Can you make sure that they have enough work on their hands? And if you're hiring an administrative person, a non-production person, then you want to see how that person is going to contribute to everyone else's productivity. How do they raise everybody up and to be more productive? Because maybe you have production people working on administrative things that aren't really directly related to revenue. So that's a real key to understanding how you hire and when you hire and what you're willing to do yourself. We all have to do dirty jobs when we're growing our business, but if you are looking at that non-production person, to think about how they're going to raise the bar for everybody. But how do you really, at the ground level, contribute to labor efficiency or labor productivity? And the way to do this is to build good processes. I mean, you can bang the drum as so much, but it's really important to know that every process, every procedure that you put into place to make other people's jobs easier and more repeatable, the more efficient they're going to be. So it really pays off to do those kinds of things in your business, create those processes and procedures. But what I would say is take it even a step further. So when we think about a business and how it runs, we think about, okay, we're marketing to people, we turn those people into customers, we deliver our product or service to those customers. So think about things all the way down the line and how we can be more efficient overall. Can we market to customers in a way that helps them and their expectations of what you're going to deliver? can you engage with them more deeply in the sales process so that they are more efficient for you when you're delivering maybe a service? So there's lots of ways to build this into your business overall, and don't strictly look at just production as part of that, but the whole business process. All right, so the 4 key takeaway is cash flow. And cash flow is the blood of your business. You know that. It's really important, but it doesn't always flow directly from profit. So this part is to really understand how profit is related to your cash flow, but isn't the only piece in the puzzle. So many business owners that we work with kind of struggle to understand how profit relates to cash. So if they made $100,000 in profit, where's my $100,000 bank balance? And the reason why these things aren't completely related is that there's other cash flow considerations to take into account when you're understanding how you're producing cash in your business. And there's kind of 4 key things that would contribute to that. There's others and there's peripheral ones as well, but there's 4 ones that really impact how much cash is going to be in your bank. And a bit of a spoiler, they're all kind of negative drags on cash flow, which tends to be the way that cash works. It's always a little bit lower than you expect. But I'll go through all those 4 and how they would contribute to your cash being a little bit different than your profit. All right, so number 1 is taxes. As much as we like to do it here at Avalon is really do accrual basis accounting and make sure that taxes are accrued for so you know in your income statement what you're owing. Most small business owners don't have the means to have that level of service every single month where they have a tax accrual made on their income statement. So what ends up happening, they get their accounting done once a year, they get a tax bill, they pay that big lump sum of tax at once, and that really takes down the profit level or the cash level in comparison to their profit that they were expecting. So taxes are a big part of that. You see cash kind of coming in and you think that's all yours, and then all of a sudden the government comes with their bill and you get a reduced cash balance pretty quickly. So number 2 is repaying debt. So if you have any sort of loans that have a principal portion of your payment attached, every mortgage is set up this way. So you have a principal part of your payment and you have an interest portion of your payment. Well, the interest portion shows up in your income statement, but the principal portion doesn't. So that hits your balance sheet directly and reduces the debt amount owing. So you may see that you have made a certain amount of profit even after you've paid your interest and everything, but part of your cash flow is going to reducing the debt amount, making those repayments on debt, and that's a real drag on your cash flow. All right, number 3 is working capital. So another way to think about this is just that, hey, I started my business, I don't have a lot of cash in the bank, I've got bills to pay, but one way that I'm going to manage my cash flow is to slow pay these, like pay them a little bit later. They drag on a little bit. But once you start making profit, you're like, okay, well, I'm going to start paying these on time, or I have someone else paying them, and they, AP people don't like to pay things late. So they start making those payments and catching you up on those payments. And that can be a drag on your cash flow as well, is that you're paying these sooner than you used to. And although you're making profit now and it's coming there, you have a sort of cash being reduced through accounts payable. The other ways that this can affect in working capital is that, once you have cash as well, a lot of software subscriptions and that, for example, will give you a discount if you pay all up front. So you pay your whole year up front, you get a 30% discount. That's great for business, but it's also a drag on your cash flow because you're giving that money up front and then sort of spreading that expense out on your income statement over the year. So cash goes way down, but then you don't have to pay that again for the whole year. So that is another drag on cash flow that's working capital related. All right, the number 4 drag on cash flow is taking dividends. And this isn't going to show up on your income statement because it directly hits your cash balance and your retained earnings. And both of those are balance sheet accounts. So when you take money out in a dividend format, it's not going to show on your income statement. You're still going to show to be profitable, but that cash isn't going to hit your bank account because you've withdrawn the money. Another way this can come out is that you're, maybe making personal expenses on the business credit card, and sort of those aren't going to show up on your income statement, but they are still a drag on cash. They're still paying you out. It's still a form of a dividend, even though you're not really seeing that cash go into your personal bank account either. So that's the other last kind of critical drag on your cash flow. All right, so that's it. That's the book. Well, that's the first part of the book. There's so much more in this book. And I hope you'll pick up a copy. I'll link below. I don't have an affiliate link or anything yet, but it's a really worthwhile book. I think every entrepreneur should read it. Really handy. And this was only like the first, like scratching the surface of the first half. The second half of the book gives you lots more sort of practical advice on how to implement some of this in your business. And we use it sort of as our playbook here at Avalon as well. Love to engage with business owners to help them grow their business through this kind of method. So it's great for that. So pick up a copy and let us know what you think. Was there a good takeaway here? Let us know in the comments. What's your journey like? I would like to hear that as well. Are you building up to $1 million in revenue? Are you going 1 to 5? Are you beyond that? Love to hear about that. And what's your experience with profits? Is it directly related to your cash flow, or have you suffered some of these ills? Let us know in the comments below. And if you like this video, can you please just hit that like button? That would be great. Smash it. I don't know what you're calling it these days, but if you can hit us a like, that would be awesome. And if you like seeing videos like this, consider subscribing. We love to see you around the channel and get engaged with Canadian entrepreneurs like you. So hope to see you around the channel, and thank you so much for watching, and we will see you on the next one. Cheers. Bye.